So if you've been watching the housing market and interest rates rising to rates that we haven't seen in decades, you'd probably think the same thing that a lot of people are thinking. An adjustable rate mortgage is most likely a pretty safe bet. It's no wonder why you'd be thinking this, and many Americans obviously are, but it may be wise to hold your horses and put things in a slightly different perspective before drawing any direct conclusions here. In today's video, I've been putting adjustable rate mortgages up against current 30-year fixed rate mortgages to see which ones offer the most savings to home buyers. So make sure you stick around. With the market as it's been, we've noticed an uptick in attention around adjustable rate mortgages, otherwise known as ARMs. And it does make sense. For one thing, we're seeing higher interest rates than we've seen in a very long time. And the longer we get used to something, the more out of the ordinary it appears when it changes. It is with this in mind that many people are running under the impression that interest rates will go back down in the future once inflation's been settled. And the reality is, however, it looks quite different. And currently, an adjustable rate mortgage may not offer substantial cost savings to home buyers. As 30-year fixed mortgages rise in rates, borrowers often turn to the adjustable rate mortgages for the potential advantage of lower initial payments in the early stages of home ownership. And that's giving them the ability to make sort of larger offers on houses they maybe wouldn't otherwise afford. Adjustable rate mortgages start with an attractive low rate, but then they eventually adjust to higher interest rates after a certain period. However, as of July 5th, according to Bankrate, the average rate on adjustable rate mortgages ranging from 6.5% to 7.21%, depending on the loan, is nearly on par with the average 30-year fixed rate mortgage of around 7%. Consequently, most buyers will not experience significant monthly payment reductions during that early lower interest rate stage of the loan, and they will face the risk of the Federal Reserve maintaining high interest rates in the future. The diminished appeal of adjustable rate mortgages adds another challenge for numerous buyers who are already struggling with high mortgage rates and limited affordable housing options. This poses difficulties for those that are seeking to purchase homes but are currently unable to afford them. Choosing an adjustable rate mortgage right now rather than a 30-year fixed rate mortgage is essentially a gamble on the hope of lower rates, as the initial rate advantage has significantly diminished. A more prudent approach would actually be to lock in a 30-year fixed rate mortgage and consider refinancing if the rates drop later on. The popularity of ARMs tends to fluctuate based on prevailing interest rates, and currently, fewer home buyers are actually opting for ARMs compared to last year when they offered more savings. One factor contributing to the decreased appeal of ARMs is the current inverted yield curve, where short-term interest rates are unusually higher than long-term rates. And this erases that typical advantage of the adjustable rate mortgage, as long-term rates are generally higher than short-term rates. Though ARMs today actually come with enhanced borrowing protections, they still carry inherent risks. However, some buyers, particularly those that are planning to sell their homes before the adjustable rate mortgage resets, or individuals looking to invest in property flipping, they are some that are still choosing ARMs. One potential benefit of adjustable rate mortgages is that if rates do drop during the reset period, those who opted for the adjustable rate might secure a lower interest rate in the future, placing them ahead of buyers with a 30-year fixed rate mortgage right now. Now, adjustable rate mortgages are also gaining favor among buyers of expensive homes right now, because even a slightly lower interest rate can actually lead to a notable savings for the fixed portion of that loan. For example, consider a $2 million adjustable rate mortgage with a 6.25% interest rate, and that's fixed for a 10-year period of time and resets every 6 months thereafter. That would result in a monthly payment of approximately $12,314. In comparison, a home buyer with excellent credit that makes a 20% down payment would pay around $12,641 each month for a 30-year fixed rate mortgage at 6.5%. This translates into a monthly savings of about $327 with the adjustable rate option. Now, when the Federal Reserve eventually lowers short-term rates, ARMs might become more appealing to home buyers again. However, most buyers would need to be certain that the savings from an ARM outweigh the certainty of knowing their monthly payment with a 30-year fixed rate loan. In any case, buyers should still be very financially prepared to handle the maximum possible interest rate on the adjustable rate mortgage, even if unforeseen circumstances like job loss arise. And I think it's prudent to avoid adjustable rate mortgages right now and make sure that you're getting into a 30-year fixed rate, stable, solid loan that you can afford. Now is not the time right now to overreach when it comes to buying a house. That way, you're going to be well prepared. You'll be set no matter what happens to the interest rates in the coming years. It's unknown to everybody. Now, if they go down, you can always refinance and take advantage of those lower interest rates at that time. But the most important thing right now is make sure you're not overspending on your housing. Make sure you're not overspending on unnecessary discretionary items. Budget very closely. Let us know in the comments below. Do you think the rates are going up or going down in the future? Look forward to seeing what you guys are posting. And until we catch you on the next video, make it a great day today and keep on cash flowing.
Money